Welcome to this lecture on retirement benefits. Okay, so when we start looking at retirement benefits, it's important for you to understand that what we are going to be focusing on here mostly is when a taxpayer receives a lump sum. Now, a lump sum is basically exactly what the word suggests. It is a sum of money in a lump. So it's a mountain of money, hopefully, if you're lucky. Basically what it means is you might belong to a fund, right? So let's say a pension fund. Now, throughout your life, you make contributions to the pension fund, right? From a tax perspective, you get a Section 11F deduction for that. That's a retirement contribution deduction. From a fund perspective, you are making contributions to the fund. They will invest your money, right? Your money, and hopefully it will have some returns. And then one day when you retire, they will pay out the money to you. So let's say you put in over your lifetime R1 million worth of income, and when you retire one day, they say to you, there is now, let's say, R6 million available in your pension fund on your account. So you've made contributions, it had some great growth as you can see here, just for the example. Now, this R6 million that belongs to you is going to be paid out in two ways. They are going to give you an annuity. So an annuity is every month, once you've retired and you've contributed to pension fund, you'll receive a pension payment. You'll go and get your pension, you'll receive your pension. So every month they give you an annuity, right? But you're also allowed to take a part of that as a lump sum. Now, that part, let's say, is R2 million. That R2 million means you can take R2 million in one big chunk of money, and that will be paid into your account. Now, that still has to be taxed. There's no exception that says one day when you retire you don't have to pay tax anymore. It might seem a little bit strange for you at first. The theory around that, or the thinking around it, is if you say that people who have retired do not have to pay any tax, then it means that the people who have not retired, the working people, will have to pay more taxes. And it's better to spread the tax risk amongst everyone rather than just focusing on some. Okay, so that's R2 million over there as a lump sum. So we need to know how are we going to be taxing that, and that is what we're going to be looking at. What I want you to understand, though, is that you can receive that lump sum from two places. You can receive it from your employer or from a fund, like a pension fund. Now, if you receive it from your employer, let's say you are working for Coca-Cola and you've worked there for 40 years and now you are retiring, and your employer says, thank you very much, and here's a lump sum because you are retiring. Right, that will be a lump sum from your employer. And you'll see that that might also be taxed in a slightly different way. Right, now, what you'll see is that these lump sums that we are going to be looking at will be taxed using separate tax tables. So they have their own special tax tables. Now, right now, what that means for you is thus you will perform a separate calculation. And basically what you'll just do, this just means is understand this is still gross income. It's still gross income for you, but you don't include it with the rest of your things like salary and your fringe benefits and so forth. You don't include it with that because it has its own tax table. All of these retirement benefits are discussed in the second schedule, guys. That's our references here. Remember, the different sections in the schedules are not called sections, they're called paragraphs. So not section 1, section 2, section 3, it's paragraph 1, paragraph 2, paragraph 3. Now, very important, I've already made the comment that when you do these calculations, you are going to be doing it in a separate calculation. But I've said to you also that this is still normal gross income, so it's still normal tax. So what I want you to understand is the following. You will do a separate calculation. So, right, let me just quickly illustrate it for you. Two ways of doing it. If this is your script, the one way, and this is what I prefer, is to have a separate calculation for lump sums, right, where you'll have your description, calculation, and rands columns, and you'll do your calculations there, and then on the next page you start your normal tax with your CGT and rands columns, right, and description, calculation, etc. You can do it in that way. That is the method that I prefer. This is not necessarily a method that they always prescribe in textbooks. In textbooks, what they like you to do is they say, don't do a separate calculation in that way. All that you need to do is have a separate column in your calculation, and then you do the lump sums in there. Now, you are obviously free to do that as well, guys, if you prefer that. Personally, for me, when I attempt questions and write them out, I don't have enough space then to do all of a column for CGT, a column for rands, and a column for lump sums. I don't have enough space then to do calculations and things, so that's why I don't do it. Right. So, regardless of how you do it, whether you keep it separate or you put it in a separate column, understand that it's a separate calculation. So you'll calculate this tax separately. Now what I want you to see is when we do our calculation, here we've done our taxable income calculation. This is your normal taxable income, salaries, fringe benefits, etc. You'll calculate your tax with the tax tables. You will get all of your section 6 rebates, the primary, secondary, and tertiary, as well as any 6 quad if applicable. And very important then, here you then add your other taxes. So the tax on the lump sums plus your section 12 T, the tax-free investments tax, as we discussed previously, will also be included there. Not a focus for this. Right, so your tax and your allowances get included there, and then, guys, you do your medical, section 6A and section 6B. It's very important for you from an exam perspective to see where this comes in here. You will not receive your marks if you do not put it in the right place. That then calculates your net normal tax. From that, we deduct our prepaid taxes, and then we have our tax liability. Again, focus on where these other taxes go in. Now, I've said to you that lump sums form part of gross income, and here's just for the references for you. The lump sum from your employer is discussed in paragraphs D and paragraphs F of the gross income definition, those special inclusions. That means it's always gross income, and from the fund, it's basically in paragraph E. So we are going to start our discussion with the lump sums from funds, so from pension funds and so forth. Now, guys, the type of funds that we are looking at are pension funds, provident funds, and retirement annuity funds. Now, this is a lecture on the tax implications. It's not a lecture on how funds work and so forth. That's not tax. But just a little bit of a quick understanding for you. All right, what I think is important. Pension funds and provident funds. Those are linked to employers. So what that means is the following. If you are working for a company, so let's say you are working for Microsoft, you will belong to either the Microsoft pension fund or you will belong to the Microsoft Provident Fund. Now, I'm not saying it is an option for you. This depends purely on your employer. They might have a pension fund, they might have a provident fund, they might have some combination of both for new and old employees, whatever the combination might be. But understand that it is linked to an employer. So if you belong to if you work for Microsoft, you'll belong to their fund. So this means that one day, if you resign from Microsoft, let's say you find another job elsewhere, you may no longer belong to the Microsoft pension fund and the Microsoft Provident Fund because it's only linked to the employer. Now, the details around pension and provident funds, exactly how they work also, guys, it's a little bit beyond the scope of this, and I'm definitely not an expert in it, but basically a pension fund, just in simple terms, you will make a contribution every month, and the rules of the fund will say that you will be entitled to a certain percentage of your final salary. So they might say you can get your final salary when you retire one day, 80% of that for the rest of your retirement, of your life, and increasing by inflation. So, understand what I'm saying there? You make contributions each year, they invest it, and then the company's pension fund must pay you a set amount. So, what is the problem there? The problem is there that, for the employer, the problem is there that if you put contributions into the fund, let's say R1,000,000, and the fund managers do a bad job and they don't invest it, and that R1,000,000 loses money, or it doesn't grow by enough, then one day the company was going to have to feel the cost of it. So understand what I'm saying? They need to pay you, let's say, 80% of your final salary for the rest of your life, and they expect that to be 20 years. That R1,000,000 might not grow enough to pay that, so then the company has to pay in. That is why we don't see as many pension funds anymore. What we see more often now are provident funds. Provident funds, you make your contribution, but they don't tell you exactly necessarily how much you will be receiving one day. So they'll say, we'll take your money, we're going to invest it. If it grows by a lot, you get a lot out. If it doesn't grow by a lot, sorry, you're not going to get as much out. So that's a big change. So the risk has shifted. With the pension fund, the risk is for the company. For the provident fund, the risk is for you. And that is why companies prefer to have provident funds now. But regardless of that, guys, the tax implications for those will basically be the same, as we'll see. So understand, I'm making the comment again. If it's linked to an employer, so if you belong to Microsoft, you might belong to their pension fund or their provident fund. But if you leave them, you may no longer belong to it. That's an important implication potentially there. Then we have a retirement annuity fund, or an RAF is what we quite often call it, you'll see. And an RAF is not linked to an employer. So this is, if I go to Old Mutual or Alan Gray, or one of these funds, or fund managers, and I say to them, listen, I want to make a contribution to a fund, I want to supplement my income one day, then they'll say, fine, you can do it. You and the rest of the public are allowed to do it. So if I change employers, I'm still contributing to the same fund. It's not linked to my employer, so I can continue contributing to it for just as long as I'm a member. That's important. Now, I've already mentioned to you, so basically what they'll do is they'll take your money, they'll invest it in these funds. So you will put in 10,000 rands a month one day, let's say, and then this money will be invested. And then one day when you retire, they say, okay, we now have 5 million rands, which belongs to you. That's all of your money you've invested. It's grown, it's got some interest. There were some dividends that you received. We sold some, we had some gains, whatever the case might be. There's now 5 million rands worth to you. Now that 5 million rands will be paid out in the form of an annuity, a compulsory annuity, and a lump sum. You can choose usually if you want it as a lump sum. Now, I'm not going into the details of this again, guys, but just that you understand, currently for a pension fund and for the RAS, basically, you can only take a third of that as a lump sum. So the government is worried that people take the full amount and they blow their money and then they have a problem. So they say, no, you can only take 1/3 of that. The rest of it will pay out as an annuity on a monthly basis. Provident funds have traditionally not had that limitation. So for a provident fund, you could cash out everything if you wanted. However, as you may be aware in South African politics and South African environment, this has been a challenge over the last couple of years, and they want to change that so that provident funds can also only take out a third. It was supposed to happen a year or two ago. It's been pushed out and pushed out. It's still, it is expected to come in next year, but it's not a concern for you from a question or an exam perspective, any of these things, because they will always in an exam give you the correct amount. So they will not tell you that there's 5 million rands available and they paid it out and you should know, it was wrong, you should only have a third. They won't do that. You're not supposed to be a fund manager or a fund expert or a pension or retirement expert. You're supposed to be a tax expert. All right. Now, guys, that annuity amount that you receive, that will also be included in your gross income, because remember paragraph A of the gross income definition tells you all annuities must be gross income. You will then see that there is an exemption section, section 10 capital C, for compulsory annuities. And basically, this is past contributions disallowed as deductions. Right, because you'll remember in terms of section 11F, your retirement deduction, you might contribute an amount, but there are limits, and it might be limited, so some part of it might be disallowed. And you'll see section 10C will be applicable to these annuities. Right. Right, so when we look at our lump sums from employers, please understand now that you'll see that we have two separate tax tables that can apply to lump sums. We get what is called a withdrawal table, and we get what is called a retirement and severance benefits table, or retirement table just for now. Now, these tables are quite important. What I want you to see with the withdrawal table, look how nice this is. The first 25,000 rands of lump sum that you receive will be tax-free. That's great, isn't it? However, look at what happens when you retire. The first 500,000 rands of a lump sum will be tax-free, which is significantly more. Now, what is the difference between a withdrawal and a retirement? Why is there differences? Why do we have differences in the tax tables? Okay, now, let's have a quick talk about it. So, before we look at all of these small detail here, let's just have a very simple explanation. You work for Coca-Cola, right? And you belong to the Coca-Cola pension fund. Right. You were an employee, if you're an employee, for 5 years. You then change jobs. Right, so you go from Coca-Cola and you now go and work for Microsoft, let's just say that. Okay, so what do we know about pension funds? If you're in a pension or a provident fund, you belong to, it's linked to the employer, so you belong to the Coca-Cola pension fund. Now when you go to Microsoft, you can't belong to this fund anymore because you're no longer employed by Coca-Cola. Now, this is very relevant to all of us, most of us, because we will change jobs. The moment you change jobs, the people who are looking after your money in this pension fund, the fund managers and so forth, they are going to contact you, or the taxpayer, they're going to say, listen, you can't belong to this pension fund anymore because you're no longer working for us. But we have, let's say, 600,000 rands in there, which belongs to you. What should we do with that 600,000 rands? Now, at that point in time, you will have an option. You can either take that 600,000 rands and you can transfer it into another fund. So let's say, for example, Microsoft has its own pension fund. You can transfer it into that pension fund, right? So you don't take the advantage of the money, you're just moving it, and now the new pension fund will invest it and you'll carry on. You can either do that, or you can withdraw it. And withdraw it means you say to Coca-Cola's guys, the pension fund, you know what, I want 600,000 rand in my bank account now, and they will pay it out to you. Obviously you'll get some tax on it. So that's a withdrawal. Now, which one is the right one for you to do? Guys, majority of the time, unless you have some really special circumstances, you should be transferring it to a new fund. So obviously that you have more money when you retire one day. Withdrawing it is not a great thing. And I've had friends, chartered accountants, who change jobs, then withdraw their pension fund, and then take it and go on a holiday to Mauritius. Now, it sounds all fun and everything, guys, but that is really terrible use of your money when it comes to tax because of these tax tables. So I said now to you guys, let's say that there was a lump sum of 600,000 rands which you could take. Right. That 600,000 rands, if you withdraw it, the tax on that will be 18% of the amount exceeding 25,000. So 18% times 600,000 minus 25,000. right, 103,500 rands. If she wasn't withdrawing it now, right, if she transfers it to another fund, there are no tax implications now, as you'll see. But let's say she's now proper retiring and she could pull that money out. What would the tax be on it then? It will be 18% on the amount exceeding 500,000. So 18 times 600 minus 500, so that's 100,000. So that is 18,000 rands. Look at the difference in the amounts there. Okay, so you should, the retirement, that is why the table is like that. They are trying to encourage people to wait until retirement before cashing out their lump sums. Otherwise, they will tax you severely. So this is the way in which the government is trying to manipulate people into doing that. And it is correct. So when do you use the retirement table and when do you use the withdrawal table? You will use the retirement tax table when a person retires, when a person is retrenched, when the business closes down, or this commutation of an annuity is basically when it is transferred if the person says, I don't want to be paid out a lump sum, I just want it as an annuity. Not very common for you to see. Right. The withdrawal table you will use when there is a divorce. Now, basically what happens here is, let's say Mr. X and Mrs. X are married. Mr. X has a lump sum amount on his fund of R1,000,000. Mr. X and Mrs. X, they are getting divorced. Mrs. X receives the right to 50% of Mr. X's assets and his income. So this lump sum over here must also be paid out and split into two 500,000 rands. Now that one 500,000 rands will stay in Mr. X's fund and the rest must be paid out to Mrs. X. Now, when it is paid out from Mr. X, right, he will not be taxed on it, but it will go to Mrs. X and she will be taxed on it under the withdrawal table if she does not reinvest it. Right, so that's basically the idea behind that. If you transfer between funds, you will use the withdrawal table. Now again, this is also if you're exiting, this is basically if you're leaving the company and you withdraw it. So from Coca-Cola to Microsoft and you don't pay it into another fund. And it says here transfer between funds, but it's just to say to you, you'll perform it in this calculation, you'll see there's no tax effect. And then a proper withdrawal is what we've seen. Right. So that's the most common one as you see here. You'll see in a second how you use these transfer between funds.